Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Birkenstock, ticker symbol BIRK. Let's just get right started. So, this is a shoe company. It's just going to be a company that sells shoes, clogs, sandals. People really like them. I know a lot of people that kind of swear by them at this point. Apparently, they're very comfortable, they're super durable, and well, you're really paying for that price. I think I haven't really paid that much for shoes in a while, but people are clearly paying for it. And you can see in their latest earning presentation, apparently they have huge consumer penetration in the US, with the average US consumer owning 3.6 pairs. That's crazy. That's a lot of Birkenstocks. So yeah, they do have loyalty. I think I know some people who are pretty big Birkenstock fans and swear by them, and once they start going bad, they just buy another pair, etc. And it's an older brand, but they only recently went public. And they do have a vertically integrated supply chain, so they don't suffer from some of the supply chain issues that other companies may, especially other similar companies. And they also have a good financial track record, according to them, where the revenue compounded annual growth rate is around 20%, the gross profit margin is 60%, and the EBITDA margin is 30%. Wonderful. And the white space is what they're saying is the Asia Pacific, Middle East, and Africa region is not a region of high penetration for them. They haven't really done all the expansion that they can do through there, and their direct to consumer still also has to expand a lot more. So that's just something that is in the horizon and shows that they clearly have room to grow, as well as with some, for example, closed toe shoes, orthopedics, and professional shoes, which is something that, for example, Crocs has. Crocs, for all their clogs and sandals being the most popular thing, they do have professional shoes, which is actually really cool if you swear by Crocs and you want to be a nurse, or you want to you have flat shoes because maybe that's what your work attire requires. You can get those. So this is a growth opportunity for Birkenstock. It's pretty great. Now, the revenue has grown at about 20% year over year from 2014 all the way to 2023. That is monster growth. Will this remain? Well, we'll see. It's much easier to grow from 292 million to 1.4 billion than from 1.4 billion to about 30 billion. So I wouldn't be surprised if this doesn't hold for the next 10 years, but it's still an impressive track record, and those double digits will probably hold at least for a while. Although you will see, for example, from 2019 to 2020, obviously a very special situation, but they're not recession immune, right? When people are not earning as much, they are not buying Birkenstocks, especially with how expensive they were, as we saw. So, here is sort of the distribution of the revenue. You have more business to business, wholesale stuff that they sell rather than direct to consumer. They want to expand that because direct to consumer makes way more in margins, right? You don't have to actually spend money to sell at wholesale at a lower price to suppliers such as Foot Locker or something like that. You are just selling direct to the consumer. All the money goes to you. It doesn't go to the third party provider. And the revenue distribution is mostly the Americas, then Europe, and as you see, they have very little penetration in the Asia Pacific, Middle East, and Africa sort of sector. So that's an opportunity for growth, although we'll see how popular they do or don't grow over there. They also have, as we see, these are for the last 2 years, they had a huge increase in revenues, although and in gross profit too, which is great. We love seeing gross profit increase because it means that their supply chain is getting more effective. Their cost of making one more pair of shoes or sandals is actually lower. That's wonderful. That is great for any company. However, their selling and distribution expenses and their general administrative expenses went up by monster numbers. This is mostly because of some restructuring things, some salary raises that they had to do, and then a few supply chain things. So the operating profit is actually down, and the operating margin especially is down, and the net profit also took a hit. You will see here that in their annual report, which is what you have to read if you're going to invest in this company, they are attributing this to an increase in selling and distribution expenses and general administrative expenses, as well as foreign currency changes. Those will always affect Birkenstock being a German company. Also, at the end of the day, their cash position is actually really strong. Look at how much cash they got into their balance sheet, 57 million and 58 million respectively. So their cash position is getting better, which is pretty great to see. They are also deleveraging. So they used to have a lot of debt relative to EBITDA. So essentially 6 times net debt to EBITDA. Now they want to bring it all the way down. So they're very rapidly deleveraging. They want to essentially, right now it's around 2.5 times or somewhere between here, 3.1 and 2.5 times. What they want to do is bring it even lower if possible. So this is great. The reason why is because if this company were to go bankrupt for whatever reason and they have debt, they have to pay all that back first to their senior note holders, to the banks, etc. And then if anything is left over, then it's paid to the shareholders. So the lower this ratio, the more we would get paid back. So this is pretty great. Their commitment to deleveraging is important because they do have quite a bit of net debt. And that's important to take in mind as we look at the cash flow from operations, which, as you will see, has been increasing solidly. However, the inventory changes have been hurting them. So if they can get rid of this inventory issue that a lot of retail companies found themselves in after 2021, after these years where a lot of people had a lot of money, this is important. And the cash from operations will be way more, which will make free cash flow be way more. Their capital expenditures are also ramping up. This makes sense. They are growing. We'll have to see if this is just a natural growth thing or if it's something where they're truly trying to spend more in capital expenditures now to hopefully get more in the future. But notice, for example, 1 year free cash flow is going to be, let's say it's $270 million here in 2023 versus the net debt of $1.4 million. That's a lot of freaking money. So they do have a lot of debt. They have to start paying it off soon because otherwise those interest payments are just going to be a whole lot. As a matter of fact, I don't see any interest payments here. Well, the finance cost, actually, it's pretty huge. It's $100 million. That's a lot of money that's going away every year because they have all that debt. So paying it off is very important. Now, I am going to calculate the value of Birkenstock in a quantitative basis with a discounted free cash flow model. What I'm going to do is I'm going to get revenue estimates. I'm going to Yahoo Finance, going to the analysis tab, and there's revenue estimates for the current year, 2024, the next year, 2025. I'm going to grab the low estimate of these just to be conservative. However, the range isn't too huge. It's going to be $1.83 billion to $1.9 billion according to analysts. Now, I am also going to just look at the average free cash flow to equity to revenue ratio. And essentially that ends up being around 15.5%. It's the number I'm going to use. We only have 3 years of available data. I would like more, but just for example's sake, I'm going to use this average. And basically, I'm going to say that these revenue numbers, 15.5% of these are going to be the free cash flow, and that's it. So 15.5% of these numbers in 2023, 2024, and then I'm going to grow the revenues by 10% in 2025 and 2026, and then I'm going to grow it at 5% in perpetuity. Okay? So with those values all plugged in, with a required rate of return of 11% divided by the total number of shares out, I get a fair value of equity for Birkenstock of $30.26. However, as I said, they have a lot of debt. So if we get their net debt number, which is $1.7 million roughly, then their fair value post-debt will actually be $21. Okay? So let's take a look at where Birkenstock is now. Well, it seems like it's nowhere near. And you'll see something. It's a recent IPO. Usually, it's kind of common knowledge that you shouldn't buy IPOs, especially if they go up after the IPO, because usually those will be overvalued for a while. You can see this reflected in the PE ratio. It's a 3-digit PE ratio, which is freaking huge. So either their earnings have to go up massively or their price has to go down a lot for the PE ratio to go down. So this will happen. We just don't know which it's going to be. And it's more likely than not that it's a mix of both. So that's just important to note. But right now, yeah, if you held it at IPO, you're pretty happy with it. But I would say if you're looking at buying it right now, it just doesn't look like the best buy ever. When giving it a 5% perpetual growth rate, we're going to say it's growing at 5% forever, right? And even then, to me, it just doesn't reflect that value. It could grow by way more. And I'm giving it a 10% growth rate for 2025 and 2026, around 16% for 23, 24. I think this is realistic, but if you really think they're going to keep doing 20%, maybe these numbers look different to you, and maybe this value is justified. But to me, it's a little risky. So, in summary, there's tons of growth, tons of potential here, but it's a little too expensive at these prices for me. It's just anything could make the price drop. And as we saw in 2020, their sales were pretty flat. So if right now there's an economic downturn in the world and people aren't buying as many Birkenstocks because that's at the end of the day an optional expense, their price may halve easily. Now, the debt situation and the lack of share buybacks may slow down returning value for shareholders. If they're not paying down debt at enough of speed, that's $100 million in free cash flow that go away every single year. That's less free cash flow they have to pay a dividend, to pay shareholders, to expand the company, etc. However, if you can buy below $30, you can participate in the full growth trajectory at a more reasonable price. Especially if you think all this debt just doesn't matter that much, then you can just say, okay, under 30, that's a pretty good deal. Okay? So my overall lesson here is going to be that you have to be a little careful overpaying for growth. Birkenstock is an amazing company in terms of growth, but there's a few things here. One of them is we only have 3 years of public financial history, so it's a little bit hard to see how their margins have done over time. The second one is simply that even though the growth is great, the price is not. So you have to be very careful overpaying for growth, because your returns won't be as great as if you pay an undervalued or even a fairly valued price for these types of growth. With that said, I hope you found this analysis useful. Thank you so much for watching. If you want to see more videos like these or want me to look at other stocks, well, comment below and don't forget to like and subscribe. It helps me a lot and I appreciate it a ton. With that said, I'll let you have your time back. Thank you so much for watching and have a great rest of your day.